Thanks, Kelly. Thanks very much for having me.
I was looking back over the stock performance. It really ran into the end of last year. And I wonder if this was just one of those show me years where, you kind of priced in a lot of the excitement and then you get a lot of good headlines this year, but investors are already looking for, maybe better bottom line results, for instance.
We've been guiding, pretty accurately on our top line. In fact, we're beating guidance on revenue. We've raised guidance for Q4, and we've set expectations that from an OpEx perspective, we're in investment mode. This is a massive market, and we're in investment mode, and we expect to glide slope to profitability in time. But we don't want to squander the lead we have in this market, so we're investing heavily to take share.
Could you tell investors when to expect that inflection point so they can all get in at the right moment? When are the shares going to start to hear from you? Yeah, and obviously they want you to be in investment mode to kind of be in the lead in the long run. But when do you think the narrative is going to start to change?
I think when people start understanding how the industry actually works, Kelly. I think there's quite a bit of noise out there right now, and it's just going to take a while for investors to understand how to judge companies like ours.
And what would you say, when we talk about you guys as an EV charging network, and obviously as the space gets more crowded, what differentiates you from others?
Well, first of all, we've been in this industry for 14 years. So breadth of product line, amount of capital raised as a pre-public company, $640 million in paid-in capital as a pre-public company, and then obviously the proceeds from the IPO. Significant operations in 2 continents, operating in every vertical of EV charging that we can think of anyway. So breadth of product line, breadth of sales reach, breadth of channel, breadth of everything, ability to handle scale. All those things are things we think significantly differentiate us.
Let's talk about profit margins, which were better than some analysts expected, and that was with a headwind from supply chain issues. Is that right? What's profitability likely to look like for the next couple of quarters?
Well, we're continuing to improve margins. Obviously, that's more of a challenge in a supply chain constrained environment because assurance of supply limits the velocity with which you can make changes in your supply chain. You can't have it both ways. And as you've seen, we're meeting or exceeding the high side of our revenue range, which means we're really stressing our supply chain. Rising to the occasion, of course, is our ops team and our engineering team making that all happen. But our margin performance as a result is a little behind where we expected in a non-supply chain constrained environment. But we're continuing to make margin improvement on top of having what the world would consider one of the worst supply chain environments that it's ever seen in recent history.
Absolutely. So let's close talking about the subscriptions that you are experiencing. You had some decent year-on-year growth there. I mean, is that going to be a really important part of, the company's strategy, and obviously to investors, maybe the valuation and the multiple over time?
It is the company's strategy. Period. Full stop. We do not sell hardware without subscription to a cloud service associated with the services the customer wants to deploy in their parking lot. So we are a cloud service. We are a SaaS company through and through. We happen to have the delivery vehicle, which is a physical charger in the parking lot, but we are a SaaS company through and through.
Understood. Pasquale, thank you for your time today and for joining us to talk about it. We appreciate it.
Shepard Smith here. Thanks for watching CNBC on YouTube.